What's up, Future Vision family? Phil here. If you're serious about trading leveraged markets, you've probably asked yourself, should I be trading futures or options? Both can make you serious money, but they can also hurt you badly if you don't understand the difference. We're breaking it down in detail, pros, cons, and exactly when to use each one. When you buy or sell a futures contract, like the E-mini S&P 500 and S, NASDAQ and Q, or crude oil seal, you are legally bound to fulfill that contract unless you close the position first. And futures are standardized contracts where you agree to buy or sell an asset at a specific price on a future date. Most retail traders never take delivery. They close before expiration. But while you're in the trade, you're exposed to the full move of the underlying. Futures are popular with Dorgov and tree traders and swing traders who have high conviction on direction. Leverage is massive. You control a huge notional value with a small margin deposit, and 5 to 12% depending on the contract and volatility. Futures are popular with Dorgov and tree traders and swing traders who have high conviction on direction. Options are different. An options contract gives you the right, but not the obligation, to buy or sell an asset at a set strike price before or at expiration. Call options profit when the price goes up. Put options profit when the price goes down. You pay a premium up front for this right. That's your maximum loss if you're buying options. You can also sell options and collect premium. You can lose more than what you paid for the contract. This limited risk of paste. This limited risk, one of the biggest deals of options. The difference is crystal clear. 80-20. Obligation versus right. Futures equal you must perform. Options equal you choose whether to exercise. Let's talk about risk profile. Futures offer theoretically unlimited gains and losses. Options buyers have their markup capped at the premium paid. Option sellers can face large or unlimited risk. Time decay. Futures equals none. Your P&L moves directly with the underlying. Options and buyers lose value every single day from time decay, even if price doesn't move. Sellers benefit. 4. Cost structure. Futures and performance bond sell a daily mark to market. Options equal premium paid upfront, no margin for buyers. Credit spreads, iron condors, covered calls, straddles, profit from up, down, or sideways markets. Strategy flexibility, futures mostly directional, options endless strategies. Credit spreads, iron condors, covered calls, straddles, profit from up, down, or sideways markets. Let's start with futures and their pros. Futures offer extremely high liquidity in major contracts like ES, NQ, and CL. Margin calls can force liquidation at the worst possible time. No time decay eating your position. Direct linear exposure, easy to calculate risk reward. Let's start with futures and their biggest pro. Extremely high liquidity in major contracts like ES, NQ, and CL. But then your risk profile changes dramatically. Excellent for hedging and strong directional conviction trades. One of the biggest advantages of futures is the potential tax benefits. In the ES, futures trades qualify to the 60-40 long-term, short-term capital gains rule. Let's start with futures and their cons. The biggest one is unlimited risk. Losses can exceed your initial margin. It requires iron discipline and very tight risk management. Easy to over-leverage and blow up an account quickly. One of the main advantages of buying options is defined risk. Your maximum loss is limited to the premium you paid. This makes options a strategic choice for managing potential losses. Can generate consistent income by selling premium. Long option positions offer asymmetric potential. Your risk is capped at the premium paid, while the reward can be unlimited. Hedging is excellent for protecting stock or portfolio positions from market swings. Selling options carries significant, sometimes unlimited risk. if mismanaged. Learn to manage risk effectively in options trading. Time decay works against long option buyers every single day. This is due to theta, which measures daily time decay. As expiration approaches, the option's a major con for buyers. Options trading is more complex to master. It requires understanding the Greeks, implied volatility, and strategy selection. Selling options carries significant, sometimes unlimited risk if mismanaged. This risk can escalate rapidly, leading to potentially catastrophic losses. Always manage your positions to mitigate this danger. Hey everyone, thanks so much for watching. This has been Future Vision, where we break down futures trading, real estate, and cutting-edge technology to help you level up your game.